Big technology stocks still going down today. Our next guest says, despite the volatility, he does not view this as the start of a major correction. Let's go to Martin Pelletier, Senior Portfolio Manager at TriVest Wealth Counsel with Wellington-Altus Private Counsel. Thanks for joining us today.
You betcha. Thanks for having me.
Okay, you don't see it as a beginning of a major correction. What are you watching?
Well, I'm watching liquidity. There's a lot. I mean, it may feel like it. I mean, we've got trade, geopolitical tensions. We've got big, violent swings in precious metals. You've got private credit that is not doing so well, rising sovereign bond risks, and then the software as a service that many of these stocks are off 40% from their highs. But I think what we have to watch for is what Ray Dalio calls a genuine shock, or something that's going to prick the bubble. And that means it's not necessarily overvalued markets, but something that's going to be a structural shift that pulls capital out of the system, such as sustained rate hikes or aggressive quantitative tightening, neither of which we expect to, we're not seeing any signs of.
Okay, much of this started last week, at the end of last week, when it was announced that they had a U.S. Fed nominee, and there was reaction to that. But what else sort of caused or triggered this pivot we're seeing, or investors really have more tech and software concerns?
Well, there's landmines out there, and this is where a good portfolio manager will help you avoid some of those landmines. Yes, Kevin Warsh is perceived to be a hawk, and that's caused maybe a trigger point for sell-off in some of the more volatile assets, even some of the assets like Bitcoin, for example, or silver or gold, which is starting to show signs of stability. But you look at other companies out there, United Health or AMD and others. I mean, there's a lot of volatility in certain names. And if you disappoint on your quarter, you're really going to get punished for it. And so you have to be really careful. This isn't broad-based. There are stocks that are still doing well and setting new highs. And I just think that we're going to continue to see that liquidity into the market. And certain areas will do well and certain areas won't do well. And that's what a portfolio manager gets paid to do, is to help navigate that.
Okay, where are you on bonds, and how should investors be thinking about bonds at this point?
Well, we're not a fan of bonds right now. Corporately, if you take a look at spreads in Europe, their lowest point since 2007. I think it's not necessarily because they're buying corporates and because of a higher risk tolerance and such. I think it's more of a cautious approach as to government bonds and maybe an emerging sovereign debt situation. Governments are spending recklessly, and they haven't pulled back much from COVID spending. And I've talked about this numerous times on your show over the last little while here. And so we don't want to own governments. 10-year Canada at 3.2, it's just not high enough for a yield. And Australia is raising rates, so who knows what's going to happen in Canada. So we don't want to do that. We don't want to own private credit. Certainly, some people have suggested owning private credit over governments. Look at what's happening in the capital in the private credit providers. They're not doing very well at all. And so we like to own structured notes that we've got control over the indices that we want to have them wrapped around with good downside protection. That's a much better return per risk profile than bonds.
Okay, we talked about being selective, rotation out of tech. Are you staying in tech at all? And if so, how?
Yeah, so we have we made a lot of money on Google. We tend to be a contrarian by nature, and so we've locked in some nice returns on Google. We bought them when they were out of favor, perceived to be the laggard in the AI space, which ended up not being the case. And so we've reduced our position. They're reporting fairly soon. And then we're rotated into Microsoft. And Microsoft is off 20% from its highs. And we think it's got caught up in this whole Anthropic scare. And Microsoft has got the security of your data, which I think people are underestimating. It's got a good risk-return ratio. They're going to adapt. They're going to have to adapt to Anthropic. They are with Azure Compute, which I think they've renamed. Steve Rolls from our office will be talking, I believe, tomorrow with you guys. But Microsoft is a good name to own on a sell-off and a contrarian call. And so there's some good value opportunities out there.
Okay, let's talk about energy as well. A lot of energy plays connected to the AI data center build out. Are you invested in energy? If so, in what way?
We've reduced our energy exposure and we rotated into the metal space, which turned out to be a really good trade for us. Energy companies have actually done quite well compared to the oil price. And then if you want to play the AI build out, you can do so through some of the utility companies in the U.S., which I haven't participated in, but that may potentially be one area to look at. We tend to look at the industrial metals as how that's going to benefit, like copper, for example. We have a nice position in BHP Group, and the copper demand scenario as a supply remains rather tight. And so that's one way that we're benefiting, not energy, but the metals route as a secondary benefit to the AI build out.
What about with natural gas?
Yeah, that is one heck of a ride. I mean, we saw some big moves last week, 25% down, and there's this tremendous volatility, and it comes down to the weather. And when you see weather having such a big influence, and same thing looking at the big moves in silver, we don't want to own those kind of highly volatile assets for our clients, almost like meme type moves in pricing. And that creates instability for the producers as well. Because how are they going to allocate capital to continue to bring on supply? And that, as long as that continues to happen, we prefer to probably own the producers more than the commodities themselves. And so there's some natural gas producers out there that probably worth taking a look at. But again, we're underweight the energy space, and we're comfortable being underweight.
All right, Martin, got to leave it there, sir. But thank you very much for your time.
Bitcha, take care.